Welcome back everybody, and a special warm welcome to all the new subscribers. Welcome on board. Okay, today's video we are going to be looking at how to build an investment portfolio for ourselves. So it's a really exciting video. We're going to be looking at the 3 factors you must consider when building your own portfolio. Also, the magic question. So the magic holy grail question is, what is the perfect portfolio for me? And we're going to be trying to answer that question. We'll also be looking at some top tips and some guidance. And just bear in mind, guys, this is a constantly evolving process. Your portfolio will be changing and evolving over time. So just bear that in mind. How to build an investment portfolio. Quick disclaimer.
This video is for education purposes only. You should seek investment advice from a registered professional before making any investment decision. This video is not responsible for any investment actions taken by its viewers.
So I've got to get that out of the way first. So the holy grail question, and the question that you might be thinking right now, what is the perfect portfolio for me? Well, the answer is, it depends. Let me explain. There's 3 factors that you have to take into consideration when building a portfolio for yourself. Factor 1, your age. How old you are will make a difference to your portfolio. Let's take a look. So here's a chart, price over time, and let's say this is the stock market. And what people think the stock market does is this, that it just consistently goes up over time. However, this is not exactly true. The actual stock market tends to do something a bit more like this. So you can see it has these big bull runs followed by crashes, followed by next big bull runs, followed by crashes. Because when we deal with humans, unfortunately, what drives the markets is fear and greed. So it's greed when people are buying and everything's going up and asset prices get driven up, and then people think, oh no, it's going to come down, and fear sets in and everyone panics and everyone sell, and it drops the market. And this just repeats again and again and again, and this is human behavior. So your age comes into it, because if you are relatively young, then it doesn't matter if it crashes and goes up and crashes, because you can just sit there and ride it for 10, 20, 30 years, and you will always do okay. Because here's a really important fact, guys. The stock market has always gone up. So whenever you hear people losing money in stocks, it's because they're selling at the wrong point. And if they just hold on, the stock market has always gone up. So if you're relatively young, you're okay. The problem comes, you're in the later stages of life. Now you can see these guys, they're in the stock market. They don't know this, but the stock market is about to crash, and it could be going down for 2, 3, 5 years. So if they're just about to retire, they need their money, and they've spent their entire life building this. So they cannot afford a stock market crash. So whether you're younger or older, you're gonna make different investment decisions. Factor number 2, your personal risk tolerance. There's different people in the world, right? We've got people that are just safe and secure. They don't have any flash cars, flash houses. They just they're very happy in life, don't like to take many risks. On the flip side, you've got the other side of the people, right? They love their flash cars. They like living a bigger lifestyle. They're more aggressive, risk takers. So you have to decide which category you fall into. Factor number 3, your personal financial education, or this could be known as your financial IQ. We've got some people out there that just love studying. They'll be watching YouTube videos on finance and investing. They'll be reading books and paying attention to the stock market and gold market and current events, and they're very knowledgeable about what's going on in the financial world. Then you've got your other kind of people, right? And these ones generally just like to come home and chill out, right? Just stick on some Netflix and you just want to relax and chill. Now, both of these lives are absolutely fine. You can do what you want. You just need to bear in mind that it's gonna lead to different paths. So you're gonna make different choices and you're gonna have a different portfolio because of this. So let's give 3 example portfolios. If we give 3 example portfolios, you can then start to get a good understanding of what your portfolio might look like. We're going to be looking at some really common assets just to try and keep this simple. So we've got stocks, we've got bonds, we've got rental property, we've got Bitcoin or cryptocurrencies, we got gold, silver and cash. And let's see how these scenarios play out. Example portfolio number 1, we've got our guy here. He's roughly about 25 years old. He is willing to take some higher risk for some higher returns, and he's got a fairly good financial IQ. So his portfolio might look a little something like this. So half of his portfolio is made up of Bitcoin. Likes to take a bit of risks, and he sees that this is an asset class that's got a lot of potential for growth. He's going to be 30% of his portfolio is going to be in stocks, 10% of his portfolio in cash, and 10% in silver. So you can see that he's willing to take a higher risk because this portfolio might return 100% plus. So he could double his money. In fact, he could get 200, 300, 400, 500% return in a few years with this kind of portfolio. However, because it's higher risk, he's got a bigger chance of losing his money. So he has to take that into consideration for himself. Next up, example portfolio number 2. So here, she's about 25 years old again. She doesn't mind taking a bit of risk because she's young and she's got time to recover if she makes any faults. But this time she's got a lower financial IQ, so she doesn't really pay attention or study anything. So her portfolio might look a little something like this. So we've got a 90-10 split. 90% of her portfolio is in stocks, probably just covering the index. So she owns the entire stock market, and the other 10% she's got in cash for emergencies. Or if there's a crash in stocks, then she's got a bit of cash to buy more stocks. Now this is a deceptively simple but very powerful portfolio. I'll share with you a big stock market secret. So Warren Buffett has said that, because he started investing I think when he was either 9 or when he was 13, so he's very, very young. He's obviously bought and sold many stocks in his lifetime, and he's set up an investment company, and he sits and reads financial statements all day, every day. And amazingly, he crunched his numbers and worked out if all he did was just buy stocks his entire life and never sold anything, he would be wealthier than he is today. And his company, Berkshire Hathaway, would be making more money. So that is a powerful, powerful lesson in just buying and holding. And that's what she's done. So this portfolio might return, say, if she does well, 10% a year, which compounds. But over 20, 30, 40 years, that is going to be a very good investment portfolio. And last up, we're going to look at someone that's potentially later on in life. So we'll look at the 60 plus. Now, they want to take a lower risk because, as we saw, they don't want to get caught up in any crashes. They're maybe about to retire, so they're going to take a lower risk. But they do have a higher financial IQ. So they've spent their lives reading about things, learning about things, and they've got a good understanding of different asset classes. So their portfolio might look a little something like this. So we can see that half the portfolio is made up of bonds. So they're getting a nice steady stream of income, and it's a very safe investment. They've got 10% in rental properties, so they may own 1 to 2 properties. That's also bringing them an income. They have 20% in cash, just in case something goes wrong, just in case they want to use it for anything else. They've got 10% in stocks, so they can get a bit of return, but if the stock market crashes, they're still okay. And they've got a good 10% in gold, which is a good hedge against any crashes and has always gone up over time. So this portfolio is much lower risk, so you're going to get a much lower return. So they may only get, say, 5% a year. However, this is still a lot better than having money in the bank. So back to the holy grail question, which portfolio is right for you? Well, here's some guidance that I'm going to leave you with. Take a look at your age. How old are you right now? Are you young? Are you older? Bear in mind your risk tolerance. Are you prepared to take some risks? And also your financial IQ. Are you going to be studying the markets? Are you going to be getting involved? Or are you just going to get a financial advisor to give you some advice? So these things will determine what your portfolio looks like. A good advice is just start small. Just start with a really small amount of money, because this gives you skin in the game. And this means when you've actually got some money on the table, you will then really start learning about the asset classes. Last bit of advice, if you're unsure, then speak with a professional. So it can't harm to speak with a financial professional and get some good advice. Okay, well that wraps up the video. If you liked anything in this video, then please click the like button below this video because it really helps out the channel. If you want to keep learning more about money and finance, then be sure to subscribe to this channel. And if you've got any questions or comments on this video, then post them below now, and I'll see you in the next video. All right, cheers guys.